Big moves in the bond market, a sell-off in the 10-year Treasury, sending the yield to its highest level in over a year, matching that of the S&P 500 dividend yield for the first time this year.
And trading volume in Treasury futures at the CME hit an all-time high this week. And joining us now with her take on where yields are headed, Sharon Stark, D.A. Davidson Managing Director and Fixed Income Strategist. So, Sharon, people have been worrying that there's a bond bubble and worrying that you got to get out of it. And you actually see a buying opportunity. You're going the opposite direction. Explain.
I am going the opposite direction because I don't see a big change in the market and the fundamentals that are driving the market. For example, the economy is growing, but it's not growing that fast. The unemployment rate remains above 7%. And I think the Federal Reserve will continue to buy bonds. So not a whole lot has changed. I think the market is impatient and they'd like it to change. But given what the chairman said last week, and the written testimony, I don't see a reason for them to pull back their bond purchases.
Sharon, you're talking about the fact that you don't really see them stopping the buying and the printing, basically. It's interesting because Goldman Sachs was talking about the fact that early next year they think that they'll actually do that, which is a little later than some people are speculating, and that they'll actually raise them way down in 2015 or 2016. But in the near term, there are some people who are speculating that they may cut this down, but you don't think so.
No, right? I don't. I don't think so. Late next year is a possibility, but not this year,
and
not
you mentioned
this summer.
The 7%. I don't mean to interrupt you, but you mentioned the 7% because unemployment is just not where they want it to be yet.
That's correct. I mean, we're far away. We're at 7.5%. You saw the initial jobless claims numbers this morning were higher again. Wages are stagnating. I just don't see the type of growth we need.
And yet, I would be tempted to fire any financial wealth manager who wanted me to lock up my money for 10 or 30 years at some of the lowest interest rates in history. You're more recommending this as a trade, right? I get in, I wait for prices to go up and for the yields to come down, and then I sell out of them. You don't want me to lock up my money for 10 years in a treasury, do you?
Not in a treasury, but if you're looking at other markets like corporate bonds or municipal bonds, you know, there's some pretty compelling yields there.
What kind of yields are we looking at?
I mean, you're probably looking at, you know, 3, 4, 5%, depending on how much credit risk that you're willing to take. But I mean, certainly more attractive than what you're finding in treasuries. Yes, I wouldn't say lock up treasuries, but if you're an institutional investor and you're looking for a total return opportunity, I would think about being long.
Okay. Now, one risk here is that if I take money out of stocks and I put it over into bonds and more money goes into bonds, that sends the price of the bonds up, that sends the yields down on the bonds, and now I'm earning less return than if I just left it in the stock market. Isn't the stock market a more attractive place to park your money now?
It depends what sector you're in, and you have to be in it for the long run. Even though bond prices could rise and yields could fall, you're still going to earn your coupon. So
you're assured of that income
that income stays no matter what.
Where stocks don't do that unless they're paying a dividend.
Stocks don't do that unless they pay a dividend. So that's why it's called fixed income, and so that's why there's always, a good opportunity to mix it up.
Well, Sharon Stark of D.A. Davidson, Managing Director and Fixed Income Strategist. You tell us all about these bonds, and you're right. It's all about asset allocation and what you're willing and your risk tolerance.
Yes.
You're absolutely right about that. Thanks for joining us.
Thank you for having me on.